Morning, everyone, and thank you for joining in today for our webinar on a guide to valuation-driven investing, which is powered by the private client group of Kotak Securities. Before we start the session, I would like to introduce Akshay, who leads the investment product practice at PCG, to run you through a small presentation about the private client group. Akshay, over to you.
Yeah. Thank you, Ketki, and thank you all for joining us. Most of you would know us, but for those of you who don't, I'll just take a couple of minutes before we start the much awaited session. Just let me connect the presentation. Yeah. So Kotak Group is India's largest wealth manager, as you know, most of you would be aware about it. And currently, we manage around 2.5 lakh crores of assets. Kotak Securities is a fully owned subsidiary of the Kotak Mahindra Bank and has been one of the leaders in the equity market for the last 25 years. Private client group, which brings you this session within Kotak Securities, is the vertical which takes care of the differentiated needs of high net worth individuals. Now, looking at our proposition, so apart from our deep expertise into direct equity backed by our unquestionable research prowess, we also help you protect and grow your wealth with well diversified portfolio solutions and low cost offerings like direct mutual funds. We also help you with your banking and credit needs, and we also have offerings like SLBM. So in terms of the equity offerings, depending upon your long-term and short-term equity requirements, we have equity baskets which help you, generate long-term returns as well as, help you allocate tactically for the shorter term as well. To generate additional returns on your dormant portfolio, we also give you support on derivative strategies, which typically are strategies which help generate uncorrelated returns. On the unlisted opportunities as well, we have facilitated a few of these transactions where from time to time, as and when such opportunities present themselves, we do take it out to you as well. SLBM is something that I mentioned as earlier as well. It is nothing but stock lending and borrowing mechanism, which helps you leverage your idle portfolio of stocks, where you can it helps provide lending opportunities on your dormant investments. Apart from that, we also help bring to you any arbitrage buybacks or any such opportunities that are there in the markets. Now I'll just spend a minute to give you a glimpse of our investment process, which begins by identifying your needs and assessing your risk appetite. Once we have enough clarity on that, we always recommend that you diversify through the right asset allocation and find the adequate product fit for you. Once the portfolio is constructed, we ensure that there are regular updates and reviews on the same. In terms of asset allocation, so we always recommend that you do not have all your eggs in one basket and always diversify across asset classes. For those of you who are into trading, we have a very robust platform which is also backed by offerings such as free intraday trading. For a small subscription amount, you can get free intraday trading throughout the year, along with zero account opening fee and low brokerage on delivery trades. We have platforms across app and terminal, which have been there for a long time and are very robust in their performance. So in terms of our research prowess, so we have a very highly ranked fundamental and derivative research desk with more than 35 analysts who track more than 200 stock at this point in time. We also have a highly qualified technical research team, and we have also won several awards in the broking industry as well. Apart from that, on being a part of PCG, you get access to all our research, client meets, and conferences. We want this to be a bilateral process where you also grow your knowledge and wealth with us. And in this entire process, you are handheld through a single point of contact. So there would be a dedicated and accredited relationship manager who would promptly take care of all of your investment related needs. Apart from that, our customer service team would also be there to support you in all your requirements from time to time. So that is all from my side. I would hand it over back to Ketki to take it forward. Thank you, Ketki. Over to you.
Thank you, Akshay, for sharing this insightful information with all of us. I would now like to introduce our guest speaker today, Dhaval Kapadia, a certified financial analyst and a certified financial planner who is the director and portfolio specialist at Morningstar Investment Adviser India. Dhaval is responsible for leading Morningstar's investment consulting business in India. He has more than 18 years of experience in areas including fixed income, equity markets, and investment advisory. Prior to joining Morningstar in 2014, he spent nearly 6 years at Axis Bank leading a team of investor advisors, which were a part of the wealth management and the private banking business. He was responsible for setting up the investment and portfolio advisory platform at Axis Bank. Please join me in welcoming Dhaval Kapadia. So we can now start off with the session.
Sure. Thanks for the kind introduction, and thank you to everyone who's joined today on the webinar. And I'll quickly share my screen, and we can start off with the discussion for today. Just give me a moment. I hope my screen is visible.
Yes, sir.
Okay, wonderful. So, obviously these are interesting times to say the least. On the one hand, obviously we see, the pandemic sort of probably in a lot of countries, develop further in that sense and spread further, and concerns around the economies, not only in India but worldwide, have also been sort of rising. On the other hand, if you look at financial markets, particularly equity markets, across the world, after the sharp sort of correction that we saw in March and April, we've seen a sharp recovery across sort of most markets as such. And you know uh, now, probably, markets in India, for instance, Indian equities are probably just off, about 8 to 10% from their peak levels in seen in Jan 2020. So, what does all this sort of mean for investors? Do valuations play a role? If you are a long-term investor, and today I'll try and talk a little bit about our perspective on the importance of valuations and in a way valuation driven investing as such. uh, this image out here essentially talks of how major markets across the world have moved since Jan of 2020. So what we've done out here is we've rebased to 100 from Jan of 20, and then looked at a mix of international markets along with India. So we're looking at the S&P 500, which is obviously the broad US equity index, MSCI emerging market, Europe, UK, and then the BSE 500 in India. Most markets, as we can see out here in March and April, saw a sharp correction as such. Since then, there has been, like I said earlier, a fairly strong recovery, which has surprised a lot of people. And in fact, now if you look at the US markets, they've seen the strongest sort of recovery, at least over this time period. And they've in fact now, the S&P 500 at least is above the levels that we saw in the early part of the year. So, and emerging markets as a basket is also above, the Jan 2020 kind of levels. Whereas if you look at Europe, and particularly UK, which is the light blue line out there, has sort of underperformed most major markets, and it is still 18 to 20% off its the Jan levels as such. Whereas India and the rest of Europe are still below, although they've seen a fair bit of a recovery in India. Obviously, as probably most of you would have noticed, that equity markets are up by about 45 odd percent from the bottom if you look at the BSE 500, or actually in fact even other indexes as well. Looking at India more closely in terms of not just the recent period, but just expanding the period a bit, going back to 2018. sorry, rather 2014, and essentially looking at how different parts of the market in India have performed. Right from large cap, which is the Nifty 50 out here, to the Nifty mid cap, the small cap, and the broad index, which is Nifty 500, and the value sort of part of the market as such. So looking at how all of these have performed over the last about 5 to 6 years or so. Uh, from 2014 to 17, obviously we saw a fairly sharp rally, particularly for small caps and mid caps, and value stocks also did pretty well at that point of time. Mid and small caps were up, two and a half to three times during this period. So pretty sharp rally. Large caps also did well, but not as much as, which is the orange sort of line in the graph out here, which obviously moved up. Again, we used a rebased number to 100 from Jan 14. So large caps also moved up by about 1.6 to 1.7 times, but not as much as small and mid caps as such. And then since then we've seen a sharp sort of correction, particularly in small caps and mid caps, right into 2020 till very recently we've seen some bounce back. But largely, over the last couple of years we've seen large caps do better than small and mid caps in particular. And interestingly, if you look at where at this point of time they stand, so the mid caps relative to Jan 2014 are still our best place in terms of the value of the investment currently. And if you look at small caps and large caps and the broader Nifty 500 kind of index, they are all cluttered together. More recently, we've seen a little bit of bounce back, as you would have noticed in small and mid caps as well. What has underperformed during this period of time has been value stocks. So that sort of in a way explains partially the rally that we've seen in large caps has been driven by quality and growth over the last, particularly in 2018 and 19, and early part of 2020. Only now you're seeing some sort of a recovery or a slightly better performance from value and growth, but nevertheless they're still much below the value index, sort of, so to say, is much below the other broader sort of market indexes as such. So this is just like a recap of what's been happening over the last few years. Now, if you look at this performance in terms of valuations, and out here we're comparing three sort of broader markets or larger regions of markets: the US, Europe, and we're comparing that to the Indian markets as such. So we are looking at how valuations have moved over a period of time, and here as a valuation measure we look at something that we call as a cyclically adjusted price to earnings ratio. I'm sure probably most of you have heard of the PE ratio, which is the price to earnings ratio. In the PE ratio, the earnings are generally the 1 year trailing or the 1 year forward earnings that people track, which tend to be driven by the prevailing economic cycle. So if you're on a down cycle, these earnings would tend to be subdued. If you're on a strong cycle, these earnings would tend to be pretty strong as such. So what we do in this, what this particular measure does is it adjusts earnings based on their long-term sustainable trend growth. So if you look at that is the measure of valuation. Particularly over the last about few years as such, we've clearly seen that US markets have performed strongly, and which we we will see going ahead as well. So US markets have done pretty well as such, and therefore you see that the valuations in terms of even the cyclically adjusted PEs at much higher levels as compared to US and Europe, which have India and Europe out here, which have sort of underperformed, particularly over the last about 5 to 7 years. They've sort of underperformed the US equity markets as such. So at least for US equities, valuations are looking pretty strong. Based on these sort of multiples, US equities are trading at about 27 times based on the cyclically adjusted PE, whereas India and Europe are trading somewhere at about 17 to 18 times a cyclically adjusted kind of PE. So there's a fairly wide dispersion in terms of valuations across at least these sort of broader markets that we are sort of looking at out here. One is obviously, as we said, there's been a sharp recovery in the market, as we saw in the previous slides as well. On the other hand, concerns around growth have sort of are still lingering around, and we've seen most major world agencies downgrade forecasts for growth for this year, as well as to an extent for next year as well. The forecasts are a bit subdued in that sense. But this year, most agencies are expecting the world economy to sort of contract by anywhere between 5 to 6% or so. Similarly, for India, in April, there were forecasts which indicated that the Indian economy would contract by about 2%. Very recently, some of these agencies have revised their forecast and are now forecasting a much sort of sharper contraction in sort of economic growth in India as well. And obviously that is due to the extended lockdowns and the uncertainty around when obviously the vaccine will be available, and uncertainty around how economic growth will sort of bounce back. 2021, the forecasts do vary in the sense that in the range of for India, it's growth expectations are in the range of anywhere between about 3% going up to 9% in a couple of cases. A couple of agencies such as Fitch expect an additional fiscal stimulus to be announced by the government, and therefore they are forecasting a much higher growth in 2021. But nevertheless, all said and done, we know that there is a fair bit of uncertainty, and this is in line with, or rather, I would say, in a way, contrasts what is happening in the equity markets as such. The equity markets have been pretty strong, and the recovery has been sort of pretty strong. So, as an investor, how does one really, look at this scenario? Should do valuations play a role when it comes to long-term investing, or should one ignore valuations if you're a long-term investor? Say, you've got a horizon of 5, 10, 15 years. Should you really think about market valuations, or should you overlook those? Given that your horizon is sort of long-term. So, to try and address this point, what we did is we, tried to study how, various markets, and out here we'll talk of India first, have performed, over the last 18 to 20 years, starting 2001. We looked at the Sensex, and we looked at if you had made investments at various valuation levels, from least expensive to most expensive, what was the kind of returns that you would have generated, and if you had held for 5 years, what was that return that was generated? So essentially, we're saying that if you invested, say starting Jan 2001 in the Sensex, obviously at that point of time the market level was different. The valuations were completely different. So if you invested in at that point and you held for 5 years, what was the return you generated? And similarly, for 5-year periods on a monthly basis. So if you invested in Feb, March 2001, and so on and so forth, and held for subsequent 5-year periods. So across these 18, 20 years, if you held for different 5-year periods and you invested at different points in the valuation, and at certain periods when valuations were cheap or less expensive, certain periods when valuations were more expensive, so to say. Now, if you invested in the least expensive bucket or period, and we split these observations into 5 buckets, from the Q1 being least expensive to Q5 being the most expensive. So if you invested in the least expensive bucket or period, which is Q1, the 5-year average annualized real return. Now, what is real return? Real return is the inflation adjusted return. So we take out the impact of inflation on the return and just look at the inflation adjusted or real return. The 5-year average annualized real return, if you invested in the least expensive bucket, was at 26%, right? And if you invested in other valuation buckets, clearly, for Q2, which is the second least expensive, so to say, this return came down to about 7.7%. Similarly, Q3, it came down further, and then Q4 going to Q5, the actual average annualized real return if you had invested in the most expensive bucket and held for 5 years, now 5 years obviously, as we know, is not a short period, it's a reasonable period, holding period, so to say, but you would still come out with a negative return of about 3.6%. So you know and you actually lost money on an inflation adjusted basis if you invested in the most expensive period. But largely, as we are seeing out here, valuation clearly has had an impact on the returns that were generated, over time period. So as valuations increased, returns from Indian equities came down. And here we are looking at pure historical data, of how the Sensex has performed, across various valuation buckets. Now, the other aspect of investing is obviously the risk, right? I mean, does that also change depending on, what the valuations were at the time of investment? So we did a similar analysis to try and see, what was the maximum drawdown in each valuation bucket. So what it means is that what is the maximum fall in the value of the portfolio, which is from the peak level to the lowest level during that 5-year holding period, right? So if I held for 5 years, like we saw in the previous slide, typically the investor would have generated a positive return in most scenarios, right? Except for Q5. Which was the most expensive bucket. But during that 5-year period, what was that maximum fall in or maximum drawdown in the portfolio value, right? So in case of Q1, the maximum fall or drawdown during that holding period, 5-year holding period, was on an average 26%. And as the valuations at which investments were made increased, the drawdown levels also generally increased, barring a Q4, which is slightly lower than Q2 and Q3. But largely the trend is that, the drawdowns going up to Q5 when the maximum drawdown was actually about, 52%. So the maximum fall in portfolio value, if someone invested in the, highest valuation bucket, was actually about 50 odd percent, which is quite significant, right? So, half the value has got sort of eroded during that 5-year, period. Obviously, some of it got recovered by the end of the 5 years, but there was still a significant fall as such. So clearly we are seeing out here that valuation, even when it comes to Indian equities, did have a significant impact both in terms of returns as well as the risk or the maximum drawdowns. So is this true just for India? So we looked, we broadened our horizon. We looked at other markets such as US and Europe, which are again major markets as such, with large sort of market capitalization, and we saw a similar trend. So we did a similar analysis again, looked at the performance of investing in these markets over the last about 18 to 20 years, looked at the valuations at which investments were made, split it into 5 buckets, like least expensive, which is Q1, to most expensive Q5, and then looked at the 5-year average annualized returns. And clearly, as we see, over this time period, the returns that were sort of generated, have come off as valuations increase. So, again, as valuations were higher, the 5-year return, generally was lower. Again, it was negative if you had invested in Q4 or Q5, which are the 2 most expensive buckets. So, clearly we are seeing that, valuations impact returns in not just for Indian equities, but other equity markets as such. And similarly, if one were to look at, again, drawdowns, which we saw for Indian equities, again, largely the drawdowns have tended to increase as valuations were higher at the time of investment. And this is again, largely true for these 2 major markets. And in fact, at our own end, we've seen other markets as well. We see a similar trend. I mean, there might be a slight variation in the actual numbers, but the broader trend is quite similar, that high valuations do impact, high valuations at the time of investment do impact the returns as well as the risk that one could see in their portfolios, even over longer periods of time, such as 5 years and above as well. Keeping this in mind, we think that that in short, that the price that you pay for the value of the security or asset class that you're buying into is a key driver of the performance that you'll generate over the long term, right? So, what this simply means is that, and what we are seeing out here, I'll just quickly explain this sort of image out here. The pink line in between is the fair value of a security or asset class. You can think of it, as the fair value of, say, the Sensex or a Nifty, right? You could derive that fair value by, say, looking at forward earnings and then trying to arrive at what could be the fair value for the market as such, or it could be a stock as well, right? So the fair value generally tends to grow steadily over a period of time. That's how earnings or tend to grow steadily over longer periods of time. Over shorter periods, there can be quite a lot of fluctuation, as we are seeing now, quite a lot of fluctuation in terms of expectations around earnings growth and economic growth and so on and so forth. So the fair value, but over longer periods of time, tends to grow steadily. Over shorter periods of, but what tends to fluctuate a lot around the fair value is the price, right? Which is what we are seeing in the markets also right now, is the volatility, that we are seeing in the markets as such. But we think, this volatility can create an opportunity, for a long-term investor if you are able to buy, buy into a security or an asset class that is probably trading below its fair value. So obviously, different people may have different, estimates of fair value for a stock or for market segments, say a large cap, or for a Sensex or a Nifty or a mid cap, right? But if you are able to buy or invest, in that security, if it's below its fair value, the potential for returns tends to be greater, and the potential for losses tends to be lower, and vice versa. If you buy into a security that's trading significantly above fair value, the potential for returns tends to be lower, and the potential for losses tends to be higher. And why does this happen? Clearly, this is because, to put it simplistically, is that, what goes up must come down, in the sense that, valuations tend to revert to mean over the long term. So, when valuations are very high, when the optimism in a way, valuations in a way reflect, the mood of the market in a way. So if there is a lot of optimism and valuations are very high, markets have done very well, at some time that optimism would tend to get corrected and would come closer towards reality. So clearly, we think that this is how markets play out over the long term, and we've seen that, time and again across various market cycles, whether it is 2014 to 17, which we saw earlier, markets did very well. After that, we saw a sharp correction in small and mid caps in particular, which were, the best performing, segments during the previous time period, and so on. So we see this time and again in different market cycles that, valuations tend to sort of revert to mean in a way. So what does this mean for an investor, and how can you, as an investor really, incorporate this in your sort of investment approach as such, right? So we've just taken, parallel or a corollary kind of an example out here, to try and describe, what a valuation-driven investment approach could mean, right? So, so imagine you're the captain of a ship and you've been given, GPS coordinates as a destination, and you're headed towards that particular destination, and if after a few hours you're tired of holding, the steering wheel steady, and this is, akin to making portfolio changes for emotional reasons. So if you change course just because you're tired of holding the wheel, obviously you may find it difficult to reach your destination, right? So in a way, this is like making changes to a portfolio because you've just held it for a certain period of time. You feel that, all right, I've held this portfolio for a fair period of time. I'm moving towards my destination, but I just feel I need some sort of excitement or change in my portfolio, and therefore you try and make changes for emotional reasons. So that's where but instead, if there is a strong wind and you're blown off course, it would be foolish not to change your GPS coordinates back to to align with your destination, right? I mean, and similarly, what this means is that if for instance sharp movements or volatility that we see in the market, right? The sharp correction that we saw in March, you've seen a strong recovery now. Now, those are, probably those might, sort of blow the portfolio off its course, and therefore it might make sense to realign, in those situations, right? And not for, emotional reasons. So, we believe that, the valuation driven approach that we are referring to does the latter. So, if there is a strong wind or, there is a sharp sort of, change in course, we might, we are keeping ourselves focused on the destination, knowing the weather changes in that sense. So, we will realign the GPS coordinates to, sort of reach the destination that we are, aiming for in a way. So this is like just like I said, more of a, corollary or, separate example to try and describe a valuation-driven investment approach. So in other words, it is not timing the market. It is not like, for small price movements, you make changes in the portfolio as such. It is for, significant changes in, sort of long-term expectations, whether it is on fundamentals or valuations, is when, it would sort of, impact, the investment approach, or drive a change in the investment approach. Now, how would you implement this, right? I mean, what could be the parameters? Obviously, as we've seen, that valuations play an important role, and we definitely think that, they play a role even when it comes to valuation, asset allocation. So the decision on how much to invest in different asset classes, or within that, so how much to invest in equities, debt, even for that matter, international equities. Within each of these segments, how much should you put in, large, mid, small cap, or short-term debt, or even low credit kind of funds. So a lot of this is driven by valuations as such, along with the fundamental factors of those asset classes. So how would you build this, or how would you approach this as such? So typically, the way we look at it is based on four pillars or four parameters. The first one is absolute valuation, right? So what this means is that what we try and assess is that asset class looking cheap, relative to history, right? For instance, if I'm assessing, Indian equities at this point of time, we'll try and see, is this, are Indian equities looking cheap relative to history? Probably at this point of time, the answer might be no. Maybe in March and April, the answer might have been yes. Okay, probably they're looking cheap relative to history. So that's absolute valuation. The second is relative valuation. So what this means essentially is how is the asset class looking as compared to similar assets. So if I'm looking again at Indian equities, out here I would probably compare say Indian equities to international equities, right? So relative to international equities, how is this asset class looking like? Is it looking cheap or expensive as compared to sort of other equity markets as such? So that is the second pillar. The third one is contrarian indicators, which essentially means is that what is the market sentiment towards that particular asset class as such, right? Is there extreme pessimism, or is there a lot of optimism, right? And in a way, this is indicated by fund flows. If there is a lot of money rushing towards a particular asset class, indicates optimism, and vice versa, if money is being pulled out of a particular segment of the market, it indicates pessimism, right? So there are some additional contrarian indicators, yeah, but that's how one can view those indicators as such. And then finally, what is the fundamental risk, right? So it's not just about evaluation, but along with that, is there what is the potential for a permanent loss of capital in that particular asset class that I'm trying to assess, right? From a valuation standpoint, it may look very attractive, but if the fundamental risk is very high, then probably I need to look at it a little bit more closely. So I'll just talk about an example or illustration, in terms of how one can view using these parameters, say the Indian corporate bond market. I mean, we've spoken a bit about equities already, so I thought let's talk a little bit about what's happening in the bond markets as such, and how do we look at the bond market through this valuation lens, or through this valuation driven approach as such, right? Now, what's happened in Indian bonds over the last few months, clearly, and in fact, going back to a year almost, we've seen that money has been moving out of categories such as credit risk, or funds that were invested in lower credit paper, and moving towards more conservative credit kind of funds or holdings, such as the banking and PSU funds. So in a way, there has been a flight to safety, right? And this has been even more stronger in the current year, where we've seen, particularly, since March and April, we've seen significant outflows from, credit risk funds, and we've seen, sharp inflows into, categories such as banking and PSU or corporate bonds, which tend to invest. Obviously, the banking and PSU invest, largely in bonds issued by banks and public sector units, whereas the corporate bond category tends to invest more in at least 80 to 90% in AAA kind of holdings. So in a way, there has been a flight to safety, due to concerns around downgrades. Obviously, we saw Franklin Templeton issue and so on and so forth, which has driven some of this change, over the last few months as such, right? So in a way, this indicator sort of indicates that there is a fair bit of optimism around high credit rated paper such as banking and PSU, whereas investors are sort of pessimistic towards low credit or funds that are investing in low credit papers as such. Now, if you look at what has happened due to this, shift or in fund flows towards banking and PSU or safer credit as such, yields for PSU bonds. So out here we plotted how yields for AAA and AA rated PSU bonds have moved over the last about year or so, and we've clearly seen that they've fallen quite sharply, right? We've seen since Jan of 2020, they've fallen by almost AAA PSU bond yields have fallen by almost 200 basis points or almost 2% as such. So from about 6.7, 6.8, they're now down to about 4.76 or so, and this is for the 3-year kind of PSU bonds as such. Now, similarly for AA as well, you've seen a sharp fall, although most of these funds would tend to invest in AAA and to a certain extent in AA. You've seen a similar fall for AA, by PSU or public sector sort of bond yields as such. Now, on the other hand, if you look at the left-hand side, which is corporate bond yields, again here you're looking at AAA, AA, and A-rated bond yields. They too have fallen, but not as sharply, and they're still fairly higher or slightly higher as compared to at least AAA rated PSU bonds as such. So in other words, they've seen a fall as well, particularly over the last couple of months, but the fall has not been as sharp as in the case of PSU bonds as such. And if you look at the yields for AA and single A rated paper, they are fairly higher as compared to PSU sort of bond yields as such. So that is a reflection of the fund flow. So more money is moved towards banking and PSU, which is driven down the yields as such. So more there is more demand for those papers as compared to the supply at this point of time, and vice versa for AA and single A rated papers, where the demand has reduced, so the yields haven't really fallen as much. So that is one way to look at it. When we talk of yields or corporate bonds as such, another area that we tend to look at is the spreads over government securities, right? So as we saw in the previous slide, yields across most of these bonds have fallen, right? But so has the government security yield fallen as well, right? So what is the spread between the government security and the corporate bond of PSU? So this indicates the level of credit risk or how much people are willing to pay for the risk of owning a corporate bond or a public sector unit as compared to a government of India bond as such, right? So this is what the spreads talk of. Now here we're looking at PSU bond spreads over 3-year government security yields. So over the longer term, right? Or longer term, when I'm saying over the last about 5-6 years or so, these spreads on an average have been at about 75 basis points over the 3-year government security. So if the 3-year government security was trading at 5%, the corporate bond over the last few years, the PSU bond has traded at about 5.75% or so on an average. But currently, because of the strong flows and as we saw earlier, this spread has come down to about 26 basis points. So now it's trading only at, if the 3-year government security is at 4.5%, as we saw in the previous slide, the 3-year corporate AAA rated PSU is trading at about 4.25%. So that spread has narrowed quite substantially, right, over the government security. Similarly, even for AA rated, the spread is now below its long-term average, so to say. Now, if you look at corporate bond spreads, also spreads have come down for AAA. versus their long-term average, the spreads are currently lower than the long-term average of 94 basis points. But for double A and particularly single A rated papers, the spreads are still higher. I mean, particularly for single A rated papers, the spread is at about 368 basis points, about 370 basis points versus a long-term average of about 290 basis points. So in other words, because of this flight to safety, because of this concern around credit, people have sort of sold off, low rated papers, and, spreads over there have sort of, widened, and now they are trading above their long-term averages. So from an absolute and a relative valuation standpoint, you know, uh, at least we believe that probably, banking and PSU bonds are not looking as attractive. Probably, moderate credits such as, double A rated, or to a certain extent some better A rated credit is looking relatively more attractive from a absolute and a relative valuation standpoint, which is what we saw in this and the previous slide. Now, what about the fundamental risk, right? So, typically when we say fundamental risk for bonds, it is the concern around downgrades and defaults, right? So, what we did essentially is that, credit rating agencies such as CRISIL come up with, credit default, rates as such. So they come up with rates for each segment, that this is what they are seeing, the level of defaults for AAA, AA, and single A rated, papers as such, based on, the bonds that they are rating, based on what, they are seeing in the corporate bond market as such. So the yellow, points out here indicate, the default rate that these agencies are talking about, right? So just CRISIL. So what we did is we adjusted this default rate to a higher level, saying that if, besides what the rating agencies are talking about, if the defaults were to increase, how would that impact, the default rate for each of these segments, right? So that is the fundamental risk. So after doing that, we still analyze, for instance, we looked at the spreads, and we looked at, the yields as we saw on the previous slide, and we feel that, at least based on this valuation lens or approach that we are using, we see there is an opportunity in the credit market. We in fact think that, probably moderate credits such as AA and some allocation to single A, looks sort of fairly attractive, from a risk and reward perspective at this point of time, as compared to, segments such as, banking and PSU or corporate bond, which is seen, spreads reduce and yields also drop off a fair bit. So that is, one way to sort of analyze, the corporate bond market as such, and this is how we are looking at it. So, another interesting sort of area that probably a lot of people have started talking of more recently, and we just come into focus, is US equities as such, right? Again, these markets have done very well over the last about 5 to 10 years, as we've seen. They've outperformed most major markets, right? So how do US equities look like? And if we were to sort of break down the performance of US equity market, what is our sort of perspective on what's happening out there? So, like I said, on the left hand side out here, you can see how US equities, which is represented by the S&P 500 out here, which is obviously the broad US equity benchmark, how that has performed over the last about 10 to 12 years as compared to all other countries, excluding US, right? So, which is the MSCI all country ex US index, right? So the S&P 500 is obviously, and we've again rebased these numbers, both of these indexes to 100, starting 2007. So over the last about 8 to 9 years or so, the US equity markets have significantly outperformed most of the countries. They're up, even after this correction, they're up more than 2 times as such, whereas most of the markets, excluding the US, haven't done as well. As you can see, this index is fairly sort of range bound at sort of lower levels as such. Now, where has this performance come from? Now, if we split the performance of the big technology companies out of the S&P 500, right? So, one could refer to them as the finance stocks, which is the Facebook, Apple, Alphabet, Amazon, Netflix, and Microsoft. If we were to strip out their performance from the S&P 500 and look at how the US markets have performed over the last 5 years, excluding those big tech stocks or big tech names, and compare it to again the same MSCI all country, excluding US index, the performance is quite similar, right? There isn't so much of a difference over the last 5-6 years. So essentially, US equities to a very large extent have been driven by the performance of these big tech names, and they are up about over the last 5 years, even with whatever you saw in recent times, they're up over 3 times, right? So clearly they have driven the performance of US equity markets as such. Now, if you were to look at the valuations of some of these stocks, right, and here we are simply looking at the expected growth rates, based on where these stocks are trading right now, the expected 10-year growth rates in terms of earnings for these stocks, right, and they are anywhere in the range of 16% to about 24% for Amazon, and which are significantly above where US companies have seen their earnings grow over the last, in fact, about from 1950 onwards, the average growth rate for earnings for US companies has been about 5% and markets are expecting some of these big tech companies to the earnings to grow at about anywhere between 16 to 24% over the next 10 years now, which is a fairly long period and which is significantly above the growth rates that we've seen over very long periods of time from US equity markets as such. Now, similarly, if you were to look at broadly for US equity markets, if you were to look at 10-year periods, again, like we said, last 10 years have been very strong for US equities. They've seen very strong outperformance. They've also seen a strong sort of growth rate in terms of earnings growth over the last 10-year kind of period as such. But what is it that is being priced in right now? Again, the market at the current levels is expecting that US equities will grow at about or the earnings will grow at about 8%, right? And historically, on an average, over the last about from 1871 to 2019, that's a whole lot of data out here. On an average, US equity or US companies have the earnings has grown at about 2% on an average, right? And there is essentially based on if you break up this performance in 10-year buckets, since we're talking of the next 10-year growth rates as such, so the probability of reaching an 8% growth rate for the next 10 years is less than 12%, based on what has happened in history. So in short, the way we are looking at US equities, particularly the big tech names, there is a lot of interest in those companies, there is a lot of interest in those markets, but we think particularly the big tech names are significantly overvalued, and US equities as a whole, as a broader basket, we think are fairly overvalued from that sense, and therefore our return expectations from US equities are sort of fairly low as such. I'm just almost at the end of my presentation, so last couple of slides. Here we are talking about return expectations from major equity markets worldwide through a valuation kind of a lens as well again. And here we are looking at major markets including the UK, emerging markets as a basket, Japan, Europe, India, as well as the US. And these are 10-year return expectations, and these are real return expectations. So again, inflation adjusted return expectations to because inflation across different countries would obviously vary. So we take out the impact of inflation and just look at the real return to to make them more comparable as such. Now, and here we've compared the returns across 3 time periods for each of these markets. What was the return expectation or estimate in December 2019, which is the blue dots that you see out here. The green dots indicate what those return estimates were in March 2020 after we saw a sharp correction in the market. I mean, the low for Indian markets or most markets was around the third week of March. So we're looking at how the return expectations were around that period and how do they look more recently after this sharp recovery as such. So clearly, most markets, the return expectations in March were much better because valuations were looking more attractive. But more recently, these have sort of, come off, and they're somewhere, in some cases, such as India and US, they are pretty close to what the expectations were in December of 2019 or at the beginning of this year. So clearly, we think that markets such as the US are not looking probably as attractive. In India's case as well, the attractiveness has sort of come off. With this sharp recovery that we've seen recently, markets are probably slightly above fair values as such. But markets such as the UK and some of the other emerging markets of Japan are looking fairly attractive, from a risk and return perspective going ahead. Again, UK, there has been a fair bit of negative sentiment. First it was Brexit, and now obviously with COVID as well. But we think from a fundamental standpoint, it should not impact the large companies in UK, which are essentially multinationals. They're getting their revenues from across the world, and therefore we find some of these markets such as UK fairly attractive from a sort of a longer term kind of a perspective. So I'll just sort of end with this quote from a popular investor, which essentially talks about speculative approaches and how easy it is to confuse genius with a bull market, right? So I'll stop here, and we can sort of open the floor for questions.
Yeah, thanks, Dhaval. So there are a few questions that we've gotten. I'll just give me a
Sure.
So couple of questions have been on themes which have taken a beating like infrastructure and also
Hmm.
uh, would you have a view on those, and apart from that, themes which have run up like pharma and telecom, what is your view?
I mean, typically we don't put out sectoral views, but generally speaking, I think obviously, sectors such as infra have been beaten down for a fair period of time, not just in the recent cycle, but they haven't done well over the last few years. I mean, barring a few periods in between. But largely, we would think that for an economy like India, obviously there are lots of concerns with the underlying companies in terms of deleveraging and so on and so forth. But largely, we think given that they've been beaten down so much, I mean, one would think that they would tend to do well, from a longer term perspective, because the valuations are fairly attractive in that space. Obviously, one has to be careful when one is picking, specific stocks within that sector. But largely, we would think that, beaten down sectors such as those would, generally look slightly more attractive as such.
Sure. We have received a couple of questions on gold as well. So people wanted to understand if gold should be a part of all portfolios, and if yes, what is the kind of allocation that one should make. Apart from
Yeah.
that, people have also asked that within gold, what are the options which you deem fit for retail investors?
Sure. So gold obviously is an interesting asset class, and we consider it to be more of a speculative asset class. Because there are no underlying cash flows, right, that you can
Yeah.
generate, from gold as an asset class. So unlike in case of stocks, there are earnings, there are dividends. For bonds, there is a coupon that gets paid out. So there is some sort of a cash flow. Even for REITs, there are underlying cash flows that you can look at. But for
Yeah.
gold, there is no such cash flow. So therefore, in our view, it's difficult, quite difficult, and it tends to get driven by more speculation rather than anything else. But given that it's performed traditionally, it's performed a pretty good role as an inflation hedge and as a hedge against economic uncertainty. Obviously, right now, inflation is not so much of a concern. It's the economic uncertainty which has probably driven up gold prices. So probably, and if you look, last couple of years, gold has done well. But if you look, the period prior to that, about 7, 8 years, gold was sort of significantly underperforming. So I would say that probably in terms of allocation, probably at best about 5 to 10% of the portfolio is something that one can look at. But at the current levels, I would be fairly cautious. They've already run up a fair bit. The rupee is also depreciated a fair bit already over the last 1 year. So I wouldn't really. I would be a little more cautious, looking at gold at this point of time.
Got it. Thank you. A couple of queries have been around performance of funds, managed funds on the equity side. So people have showed concerns around being invested for 3 and 5 years and still ending up getting in negative or low single digit returns.
Sure.
So question is that, what is the ideal investment horizon when one is looking at investing in equities?
So typically, I would say when one is looking at equity, obviously, I think the horizon should be 7 to 10 years at least. The reason is that is for what some of the concerns also that were shown over shorter term periods. We see the probability of making a negative return is tends to be higher, whether it's 1 year or a 3 year kind of period. But as you go beyond 6 to 7 years, that probability tends to come down. So therefore, I would think the horizon should be at least 7 to 10 years. Uh, but obviously, it doesn't always mean that every 7 to 10 years you'll get exceptional returns, right? It also depends on the valuations at which, at the market points at which those investments have been made would also sort of, drive that return. But the ideal horizon should be at least 7 years and above.
Okay. Uh, a question is regarding, someone has asked that is partial profit booking a good idea in value investing? Example, after 50% return achieved over a 3-year period, should one start booking profit, or should one stay invested for the long run?
Yeah, I think where an asset class is done very well is when you need to assess a bit more deeper. It's not just, I mean, just purely profit booking from that point of view, but I would say try and assess whether from a valuation standpoint, is that asset class now looking attract? Is it still looking attractive? It's unlikely given if it's generated a 50% return. But if
Yeah.
it's looking overvalued, is probably based on that you could take a call rather than just purely based on the fact that it's gone up by 20, 30, 40%. So I think it's more to do with also, in terms of valuation, how is it looking right now? But then if it's gone up by 50%, I think it's definitely a candidate for probably, booking some profits, generally if it's over a short period of time.
Sure. Uh, uh, Another question is regarding the state of U.S. economy. So the question is that even after that we have seen the kind of impact that there has been on the job market in U.S. There has been a rally in the stock market, and fundamentally, the economy does not totally reflect on the stock market in terms of the performance, and which is believe which is really believe that it is pushed by the liquidity push that has been there from the federal banks across the globe. So how long can it last, and is it sustainable?
I mean, that's the most difficult question to answer. How long can it last, right? I
Yeah,
mean,
yeah,
a
yeah,
lot of time people think that this time it's different and so on and so forth. But
yeah,
just to talk a little bit more about that, if you look at U.S. equities, like I spoke about in the slides as well, a lot of that performance has been driven by the big tech. Those
yeah,
six, seven, eight big technology companies have driven the performance of U.S. equity market. So rest of the market has really not probably done so well, right? So which is what we saw in one of the slides as well. So the point is that it's important to try and distinguish between the two as well. So we think U.S. equities definitely are looking overvalued for some of the reasons that you mentioned, but within that, some sectors such as technology in particular, we think at least in our view are significantly overvalued. So we would definitely be quite cautious, or I would say underweight on U.S. equities, particularly the big tech kind of names as such.
okay, sure. Another question regarding international equities is, apart from US, are there any other markets that one should look at? Are there any other opportunities that you?
Absolutely, absolutely. And if at least when we are looking at markets in India, or when I say India, sitting here in India as well, or globally as well, we look at many more markets. We think there are opportunities within Europe, like I spoke of. For instance, UK looks fairly attractive. Although in India it's a challenge that you don't have any investment vehicle which is available domestically to invest only in UK equities, but there are European equity funds available. So we think Europe as a basket looks reasonably attractive from a risk reward perspective. We think over the longer term, over the next 2 3 years, growth will sort of recover in some of these economies, and valuations are not rich out there. Therefore, they are looking attractive. Even as you would see, maybe pockets of emerging markets again, emerging Europe, or coming to Asia. We think Japan, South Korea, they are looking sort of reasonably attractive as well. So there is obviously a much more wider set of opportunities that one can consider and look at, besides the US as well.
Sure.
Yeah.
Uh, One last question. When choosing stock market when choosing any stock, is market capitalization an important criteria, or one should fundamentally look at a bottom-up approach where you look at the balance sheet, cash flow, and mostly most of those parameters.
So obviously the market cap will give you a sense of whether it's a large cap, mid cap, or a small cap, right? So that is important from, say, probably an asset allocation perspective, in terms of if you have to decide how much money you want to put in small caps, right? If you so there it becomes an important parameter in just in terms of probably categorizing the stock, so to say.
Yeah,
Uh, Generally speaking, it would also probably help determine what kind of liquidity would be there in that kind of stock. So that also becomes an important. Typically, companies or shares with lower floating stock or floor, lower float would tend to be less liquid. So
yeah,
that in a way is also linked to market cap. So it helps determine those kind of parameters. But purely, obviously, the other level of analysis is obviously the fundamentals. So I think both are important, but I would give more importance to the fundamentals, and then also look at the market cap in terms of the bucket. Like I said, whether they are large, mid, or small, and that would also be important to determine which category or which bucket do you want to put your money in.
sure, sure. Thanks, Dhaval. So those are all the questions that we had. I'll just
Sure,
hand it over to Ketki to Ketki,
sure,
over to you.
Thank you so much, sir. That was a very enriching and extensive webinar and a Q&A session. And I'm sure everyone enjoyed listening to your views. On behalf of our participants and Kotak Securities, I would like to thank you for taking out time and sharing your insights with us. Uh,
sure,
I would I would also like to thank all the participants for joining us today.
sure. Yeah, it's been a pleasure. Thank you.
Thank you, sir. Have a great evening, everyone.
Yeah, thank you.
Thank you, Dhaval. Thank you, everyone.